Bonds are great investment tools to add to your investment strategy as they offer inflating beating returns whilst having very low risk, adding both stability and growth to your portfolio. So in this video, I will dig into exactly what bonds are, what you need to consider when investing in bonds, which strategies you can follow when investing in bonds, as well as where exactly in South Africa you can invest in bonds. Now, this video forms part of the Investing for Beginners in South Africa series, so make sure to check out this playlist over here after this video to learn more about share, property and cash investments as well. Now, similar to shares, companies often need to raise capital in order to grow, to pay off existing debt, or to strategically invest in something, and they need money for it. So instead of selling shares to the public, a company can also offer a bond. Now, with a bond, you will typically borrow money to the company for a certain period of time, and they will then agree to repay you your full amount together with some interest. This is basically the reverse of you lending money from the bank. Instead, now you can be the loan shark. Now, when looking at bonds, there is a bit of jargon that you first need to understand. A principal or face value is the initial amount of money that you borrow to the lender. A coupon is the interest rate that is offered by the lender. The maturity date is the day that the bond expires and when the investor will receive back his capital. And the credit rating is a rating which indicates the chance of the borrower getting their money back at the set due date, or in other words, by the end of the term. Now, bonds are quite popular as they are much more stable with lower risk compared to shares and property, and they also offer better returns compared to cash investments. So they kind of hit the sweet spot for conservative investors that do not want to risk losing a lot of money, but also want an inflation-beating return on their investments. Bonds are also very liquid, meaning that you can easily sell your assets in order to get back your money. They offer stability to your portfolio as they offer passive, predictable returns. Your money is also prioritized when invested in bonds. This means that if the company to whom you borrow your money goes bankrupt, then you will get your money back first before the shareholders gets theirs. You might not get all your money back, but you will at least get more than the shareholders. Now, the downsides with bond investing is that they tend to underperform shares and property investing in the long run, and even though they do offer predictable returns, this also means that your investment cannot really grow more than the expected outcome. Now, there are basically 4 different strategies that you can follow when investing in bonds. The first is a passive or buy and hold strategy. If you are looking for a stable outcome and want to know the yield that you will be getting, then buying and selling a bond indefinitely is probably for you. This strategy assumes that the bond is safe and that the lender will not default on their debts. The second is an index matching strategy. This is where you link your bond investments to an index, such as an ETF, to try and spread your risks. The index will then buy a collection of bonds according to a set of rules, and you will earn an average of the returns over all the bonds taken out. The third is an immunization strategy. This is where the bond is kept for a predetermined amount of time and then sold completely after this time. This works great for those who know how much and when they will need the money in the future. And then the fourth one is a dedicated and active strategy. This is where people try and maximize the returns on their portfolio. They will, for example, buy and sell bonds depending on what is currently happening in the world, and will therefore take on more of a trading rather than an investing approach. These guys will need to pay close attention to things like the interest rate, valuation, spread exploitation, and timing. Now, if most of this just went over your head, then don't worry. Me too. This is meant for the experts. So if you are new to investing, rather follow the passive or index matching route, as it is much easier to learn and do not really require you to be an expert to start with. Surprise, surprise, no escaping the tax man on this one either. Your returns on bond investments are seen as interest, and this is taxed according to the normal income tax rate. If you invest in local bonds, meaning retail savings bonds from the South African government or bonds from local companies within South Africa, then you at least get an annual exclusion on your interest income of 23,800 Rand if you are younger than 65 and 34,500 if you are older than 65. But if you earn interest from foreign bonds, then there's unfortunately no exemption, and you will be directly taxed according to your income tax rate. So if you are in a very high tax bracket, then use bonds with caution, as you can be clapped with lelik taxes by the interest that you receive. Now, for more information on how exactly tax is calculated on investments, make sure to check out my other video over here on the info cards. Now, it is fairly easy to invest in bonds, and there are basically three different ways that you can go about it. The first way is through brokers and financial advisors. Now, as with any investment, you will need to know what you are doing before putting money into something that you might not understand. If you are not really interested in investing time and energy to learn how to invest yourself, then you can work through a broker that will invest on your behalf. These guys and girls are trained and knowledgeable in what they do, so your money should be safer with them. But because they offer a service, you will also need to be paying for it, and this can also eat at your returns. So if you do decide to make use of a broker, then make sure that the fees are justified by the returns. Now, these type of investments are mostly done via balanced bond-focused unit trusts, and the largest ones available will include those from Allan Gray, Coronation, Prudential, and PSG. The second way is to invest in bond ETFs directly through online brokers. So if you want to cut out the advisory fee that comes with a financial advisor, then you can also invest directly into bond ETFs on the JSE using a platform such as Easy Equities. These bond ETFs track a basket of South African government and corporate bonds with varying maturities and yields. You can either buy a vanilla bond ETF such as the Satrix SA bond ETF, or an inflation-linked bond ETF such as the Ashburton ILBI ETF. If you want to go international and want some offshore exposure, then you can even also invest in the Ashburton World Government Bond Index. ETFs are generally much cheaper, easy to learn, and are great for diversification, and something that I truly stand behind as a beginner investor. And then the third way is by means of government retail bonds. This is basically a debt instrument issued by the National Treasury to support state spending and obligations. Now, you basically get two different types of government bonds: fixed rate bonds and inflation linked bonds. Fixed rate bonds offers a fixed amount of interest for the agreed period, and the longer the term, the higher the return will be. You can choose to either reinvest the interest you receive, or you can opt to receive interest payments twice a year to your bank account. You can also restart your fixed rate bond every 12 months at the current prevailing interest rate if the interest rate were to increase after you've taken out the bond. Now, fixed rate bonds are available over 2, 3, or 5-year terms. Now, inflation linked bonds pays interest linked to the inflation rate during the investment period. Now, inflation-linked bonds are generally available over 3, 5, or 10-year terms. Now, if you expect that the inflation rate will increase over the next couple of years, then an inflation-linked bond will offer the best returns. But if the inflation rate drops, then a fixed-rate bond will probably be better off. Now, the minimum investment amount for retail savings bonds is 1,000 Rand, and the investment may also not exceed 5 million Rand, as if anyone has that kind of money. Now, anyone with a valid South African ID and a South African bank account can invest in them, but if you are younger than 18 years, then you will need your parents' written consent. You can find these bonds by either going to your local post office, by going directly to the National Treasury in Pretoria, or by searching online. Now, I will leave a link down in the description if you want to check it out. There are no charges, commissions, or costs associated when you invest in South African retail bonds, and you may withdraw money after 12 months, but this will incur a penalty, so it is best to leave these investments until its maturity date. Now, it is important to note that retail savings bonds are only seen as lump sum investments, so you cannot add money to your investments every month, as these will be seen as new contributions which will have its own separate expiration date. In contrast, with bond ETFs or bond-focused unit trusts, you can invest as much as you like, how often you like, and withdraw your capital at any time. So if you are looking for a more flexible monthly investment contribution investments, then an ETF or unit trust will probably be better fit for you. Now, bonds can form a really important part of your overall investment strategy. Although they tend to offer lower returns compared to shares, they are much more stable and thus offers great diversification to your investment portfolio, as they will offset the risks associated with shares. And due to their stability, many people also consider bonds as a pivot when disaster strikes, such as was seen during the financial crisis in 2008 and the pandemic in 2020. But when it comes to long-term investments, you will need to diversify your portfolio, and this means that you also need to consider adding things like shares, property, and even cash to your investment strategy. Now, I made a separate video on each one of these investments, so make sure to check them out in the links on the info cards, as well as down in the description below. Thank you for watching, guys. If you found this video to be helpful, I would really appreciate it if you can leave a like and a comment, as this really helps with the YouTube algorithm to show this video to more people. And if you want to learn more about personal finance, investing, or entrepreneurship, then consider subscribing so that you won't miss out on any future videos. Anyways, guys, that is all for today. Thank you for watching, and as always, have a lucky day, and I'll see you in another video next week. Cheers.